Okay, great. So
We can hear you.
tonight's topic of discussion is we want to go over some predictions for 2023. And then obviously, because this is Ken McElroy's channel, we want to tie that into what's happening with the real estate market, multifamily. And then with Hartman, we're going to hear what's happening with the single family market. Obviously, everyone's eye is on the Fed and whether or not they're going to continue to raise interest rates and what that will do to mortgages or the price of money. And as we know, there's a significant lag effect with what the Federal Reserve does and how that kind of filters through the entire economy. And as investors, whether you're a real estate investor or stock bond, it really doesn't matter. This is something that you definitely need to be cognizant of. And, it's an interesting dynamic because we can be in an environment very similar to the 1970s where we do have significant consumer price inflation, but some asset prices come down, which I think really puts the emphasis on your capital structure if you're a real estate investor and making sure that you've got that long-term fixed rate debt and a significant amount of positive cash flow. And so, Kenny, I don't know, do you want to go ahead and start there and tell the folks what you're doing with your entire portfolio in regards to 2023, understanding what the macro environment looks like right now with the Federal Reserve and potentially raising rates, or maybe in 2023, potentially pausing and cutting rates based on what we see in the yield curve right now?
Yeah. Well, I'll tell you what we're doing. Each and every week, we sit down with our investment committee, and our investment committee usually pores over 20 to 30 deals a week, and literally flying all over basically the states that we look at, and so we have acquisition guys and analysts out looking at deals, and so we had actually a meeting today, which was so it's fresh in my mind, And I was asking Bobby, the head of our acquisitions, what are you seeing this week? And because everything's changing week to week because interest rates are up, expenses are up, labor's up, utilities are up, insurance is up, taxes are up, and rents are flat. So, and the only other thing that's up right now are our sellers' expectations.
Yeah.
So what's happening is there's a disconnect between the buyer and the seller right now on their expectations, and so what we're doing is we're just holding the line and managing the cash flow as you would, George, based on where we think that is going to be if we have to use any kind of variable debt or bridge debt. So the challenge that investors have right now, that we have, and what everybody's trying to get is fixed rate debt or HUD debt or anything that's in place already that's been in place for a year or two or three, because obviously they're stepping into the shoes because it's assumable from
Mm.
from the prior acquisition. So that low cost debt is becoming a huge asset at this point. I think you and I talked about this before. You pointed it out even that, interestingly enough, and debt is an actual asset because it's 3 or 4%. And and so now you can't really buy a lot of new properties unless you're projecting 7-8% interest rates.
Mm. Yeah, right. And you said that your rents are flat. Is that kind of a recent phenomenon?
Yeah, I would say that's been going on for a little while.
Okay. So, and I would imagine the other key there with your balance sheet is to try to do everything you can to lock in a rate as long as possible because you want the liability side of your balance sheet to kind of match up with your cash flow. As far
Correct.
as, I don't know if maturity is the right word, but what you wouldn't want to do is say, okay, I've got like $1 million coming in every single month. And if my debt service, let's say all my expenses with my debt service is 800,000, okay, that's great. I've locked in a $200,000 profit, assuming that my occupancy rate stays the same and rents don't go down. But if let's say that's an adjustable rate debt reduction that goes up in, let's say, a year, and then it could go up to 10%. Well, now all of a sudden you're flipped where with the same amount of rent, your cash flow negative. So I'd imagine that's something you're watching like a hawk.
Without a doubt, yeah. So there's been a tremendous amount of equity that's been wiped out obviously on the home purchasing side. Hey, Jerry. On the home purchasing side, the home prices have gone down, so that equity's been wiped out. So people are freaking out a little bit there. But also on the multifamily side, cap rates are going up. So debt costs go up, so cap rates go up. So if a cap rate goes from 4 to 5, as you know, that's 20%. So you can work your butt off doing a value add and even increasing your NOI by 20%. But if your cap rate goes up 20%, then you basically at net zero. So we're seeing rising cap rates due to these rising interest rates. And the sellers are finally starting to, adjust their pricing, but it's interesting time. And I think that next year you're going to see a flood of multifamily and commercial properties hit the market in the first 6 months to try to capture what equity they have.
Right. Well, that's a good point too. I think we might see that to a certain degree in the single family side. So what are you doing as a strategy there? Is it kind of building up a little bit of a war chest as far as cash so you can take advantage maybe of some opportunities, and combining that with maybe a pretty conservative LTV to make sure
well, you'll love, I'll tell you what we talked about today. There's a incredible property, 400 units with a staff of 17 people, owner managed, like the perfect deal. And we're only going to get 50% loan to value, and it's like a 7% debt. So the strategy on that one was, let's buy it all cash. And then just wait, because, right now, George, it's a very weird time because debt is actually in many cases priced higher than equity, but debt is less risky than equity because in the waterfall, you got debt then equity. So the first thing that gets wiped out, let's say, in a correction is equity. So there's this weird time going on where if somebody had a fund of, let's say, 5 or 6 or even 7% on the equity, it's not very attractive because the debt is 7.
Yeah, that's interesting. So, Jason, are you seeing similar things on the residential side? And I know you've got a pretty significant size portfolio of these single family starter homes. So how are you kind of managing what we might see in 2023? No, you got the mute on.
He's hoarse.
Yeah. Yeah. Yeah, Jason, we can't hear you, buddy. So maybe, Kenny, let's just continue the discussion here.
You shouldn't have gone to that mime school, Jason.
Yeah. Well, this whole interview, Jason could just sit there and laugh at our jokes. Geez. All right. Well, we'll have Jerry work on the tech side of this, because Kenny, we could.
Now I'm unmuted.
Oh,
there. Muted now. Yeah. Yeah. It wasn't me. It's controlled by the host. So I wasn't controlling that. I think he was trying to stop the reverb before. Anyway, George, yeah, to answer your question, this is a very strange market we're in. And Kenny, I know will agree with that. Times are definitely changing. We've got this tight inventory, but we've got the buyers and sellers kind of in this sort of standoff situation. Resale properties, massive shortage of inventory, a lot of new construction properties hitting the market soon. And I think there's going to be a little bit of a glut of new construction, but a shortage of resale at the same time. I'm not sure that's ever happened before. There are signs of easing inflation. If you look at the Baltic Index for shipping, which I know, George, you probably talk about on your show, there's definite signs that these shipping costs are going down because of lower demand. And, a lot of people are talking about what happened with Black Friday and Still a lot of productivity out there, so that's a sign that prices will ease a bit because it's been pretty crazy so far. Yeah, it's a very strange time. I don't know that there's been a real estate market like this in many decades.
It's interesting the amount of economic distortions you create by shutting down an economy for an entire year.
Yep.
Hell yeah.
Shocker. Well,
Yeah, what a
so
disaster.
what are you doing in your own portfolio, Jason, to try to kind of position yourself?
We are trying to increase rents, and for a while, rents were just skyrocketing. But I got to tell you, I just released two of my properties recently and noticed some resistance. What was
Mhm.
interesting about these two properties in Florida that I just released, they both came up at the same time. This is my own personal portfolio, and both tenants moved. I was surprised they didn't stay. And one of them reached out to me after moving and said she wanted to move back in because she didn't feel safe in the new place that she moved to. And what happened is the market just left both of these tenants behind. In other words, their standard of living declined, and they can't keep up with the higher cost of housing. And I
Right.
think that is a very sad state of affairs. It's not good for society. But I think we're going to continue to see in this disaster of a centrally planned economy we have with these evil, wicked people that run it, just a continuing decline in the standard of living.
Yeah, so thinking that through from the standpoint of an investor, I think we get to a point where if this continues, the demand side of the equation puts a damper potentially on rents kind of nationwide, whether it's single family or multifamily. And I know that if I was in the game right now, I would definitely want to have something that was in a B or C type class, right? In
Yeah.
like a good neighborhood, because um, although you do have risk to your occupancy rates, you're going to have far less risk if you have a property where that people can move down into,
Yeah.
right? So, and again, what do the people do to your point that can't or that are left behind? I mean, hopefully they don't become homeless, but usually what you'll see in other markets around the world is people moving into smaller spaces.
Yeah.
So that 2,000 square foot house that used to house three people now will house six people, something like that. But the person that's making $100,000 a year that used to be able to afford a very, very, let's say an A property, well, now they might not be able to afford the A property, but they can afford a C or a B property, hopefully in the same nice neighborhood with the same school district. So I think, but I would really like to hear from you guys. How do you maneuver? Because real estate, although it's usually pretty liquid, if you've got a portfolio of 100 properties that are in this A category, and you're seeing everything that you guys are talking about in your YouTube channels, and what I talk about with the macro side of it, how would you personally set that up or transition? I mean, would you try to pull out some equity and move it into a D or C, or excuse me, a C or B property? I mean, what's the strategy there?
Yeah. Well,
From the single family home perspective, oh, go ahead, Kenny.
no, well, I was
Yeah,
just going to
you know
say,
what?
George, it's a good point. So what we do when we're looking at building brand new Class A is we look at the price of a, let's say, value add A or B. So as an example, in the city of Phoenix, you might pay $400,000 a unit for a Class A or A minus that might be able to be upgraded. But you can build that same property for say 350 or 300 depending on your land price and your construction price. So
Mm,
in that case you build, but now that's changing to your point. So that's why when we started buying in Austin, Texas, or Houston or Dallas or San Antonio, that we're buying at around $180,000 to $200,000 a unit for the same product that we would pay, say, $350,000 in Phoenix. So that's why it doesn't make a lot of sense to build in the Texas market when you can buy below replacement costs, but it might make sense in a town like Phoenix. But to your point, George, that's changing now, because those $350,000, $400,000 apartments have dropped by 20% at least in the last 8 months. So what was once, say, $400,000 is a low $300,000 property.
So, cap rate.
Yep.
Okay, so, but if you had a significant percentage of your overall portfolio in these 8 properties, what would you be doing? Like if 90% of your portfolio was something where you're like, okay, my clientele before was that person at $100,000, but now I don't know where my clientele is going to come from if everyone kind of notches down the economic totem pole.
Yeah, so for us, it depends completely on the supply of Class A in a market. So, we're building a property like right now in South Phoenix in an area called Marana. And there's almost nothing being built or have been built in the last 15 years. So when we open that property in July, we should do very, very, very well. But to your point, like when there's a lot happening in a concentrated area, then I think, well, you could see 2 things. One, you could see that the management companies are going to start discounting their rents or doing concessions, and they'll start competing with the B properties, let's say, and then the Bs have to make an adjustment.
Yeah, but your debt service cost is still at A.
Correct. Yeah, that's right. Oh, and then there's that.
Minor detail.
Yeah. Right. All right, Jason, what do you think, buddy? With your portfolio, if you had some of these 8 properties, what would you be doing?
Yeah, George, I don't think, like in the single family perspective, I don't think you need to worry too much about that, because an A property on a single family rental property might be $450,000 in, say, Sarasota, Florida, right? And you've still got someone notching down from a $600,000 home, whether they were renting or owning it, if they're going to recycle into the, I just don't think we're going to have a foreclosure crisis this time around like we did before. It's a different, this economy is a different type of disaster than the Great Recession was. A disaster nonetheless, but a different type of disaster. And so, these people there are higher level renters that will move down into these properties, or people that had to relocate to move down into them. So I don't think it's like that big a deal. Certainly, I agree with you that the workforce housing is the safest bet, but I wouldn't be rejiggering a portfolio because the cost of sale, the closing costs, it's just too expensive. And that's one of the things that makes real estate so much more, so much less volatile, is that the transaction costs are high and they're slow. And that's why stocks and hey, let's talk about cryptocurrencies at some point, are so volatile, because you can trade them with a click of a mouse at low transaction cost. Real estate is very sticky, and it doesn't change that quickly because the transaction costs are higher and the speed of sale is much slower, which is a good thing. There's lack of liquidity to some extent, comparatively to stocks and crypto assets.
Yeah. So I guess we could talk about counterparty risk. I mean, I think there's, I guess that is what's nice about real estate, is the risk involved is defined, or it's at least it's very transparent, even for the average Joe and Jane. If you were if you took the average Joe and Jane and looked at, if you took me, for heaven's sakes, and looked at FTX's balance sheet, where am I going to go with that? I don't know. It's a black box. So I don't know how to assess risk. I don't know how to quantify this at all. But with a single family home as an example, or when you get up to Kenny's world, you've got some experience in multifamily. It's pretty darn straightforward. what your risks are. And if you want to take it to an extreme, all you need to really do is back test your portfolio against the GFC and say, okay, well, how would I have done back then? And if I would have done okay, then I'll most likely do okay this time around as well, assuming that the economy declines. And I think there's a pretty significant probability, just because, again, going back to that yield curve inversion that I keep referencing, is getting pretty extreme, that's for sure. But then also, I think that, let's talk about the debt, Jason, because it's not so much in single or in multifamily where you can get the 30-year fixed rate, but you definitely can in the single family. And it's weird because I get on my YouTube channel all the time, people asking me if they should buy now, if they should wait, if they should do all these things. I say, listen, prices are at all-time highs, or they were. So you've definitely got some downside risk. And I personally just like to buy things when they're cheap and sell them when they're expensive. But sometimes that doesn't necessarily mean the nominal value or price of the house. It could be the cash flow as well. I use the example of 2012. And everyone thinks back then that prices were just astronomically low. And they actually weren't. If you look at a historic chart adjusted for inflation, they're pretty much on their trend line. But what was extremely cheap was the cash flow. That was just unbelievable. And so I wasn't really buying the house, I was buying the stream of cash flow. And if you have some properties in your portfolio that you own them, not because, and I know this gets a little confusing, but if you own them not because of the house, but you own them because of the cash flow that's attached to the fixed rate debt, then you're almost in a position where you don't care what the nominal price does. I mean, it could almost literally go down to zero, and it really wouldn't impact you because you never wanted to sell that property to begin with, because your rationale was to leverage long-term inflation and have the tenant, if you will, pay off your principal and interest over the span of the next 30 years. So it's really depending on what your rationale is and your mindset. Unfortunately, I think just the majority of real estate investors are investing almost exclusively to see the price of their house go up.
Yeah, I think.
Yeah, that's really not investing. Yeah.
Yeah,
right.
Jason and I are very aligned here, George, where most of the real estate investors, or I guess they call themselves investors, are short term. They're transactional. And if you really look at the wealth, that's been built up over years and years and years, and really the wealthiest people in the world, it's been on a much different, not to say that they don't sell properties, but primarily what they do is they hold on to that cash flowing property because that's worth significant amount of money. It's reoccurring revenue when they sleep. And it's not based on something going up. It's literally, it's got some kind of a management or a tenant or something in place, whether it's a hotel, an office building, a mall, a multifamily, it doesn't really matter, or even a business. That reoccurring cash flow is gold. And that's what's going to save people into this next recession, even if the income is hit a little bit and the expenses are challenged a little bit. The cash flow may go up or down a little bit, but the cash flow itself is gold, because you could literally be sleeping and it continues to come in.
What are the risks there, Jason? Kenny really brought up a very interesting point that if rents are flat, but your expenses could be increasing. How do you try to hedge that out?
Yeah, well, the first thing I think you've got to understand is that with an income property, a lot of the return on investment, a lot of the benefits from the property are like an iceberg. Most of the iceberg is below the surface of the water. And the amateur investor doesn't see that because they don't really learn how to do the math and how to really understand the yield on an investment. And like Kenny said, they're short-term transactional thinking, and the whole strategy they think is like a cryptocurrency or a non-dividend paying stock, which is, buy low, sell high, right? And that's an amateur strategy because you make a lot of money from inflation-induced debt destruction, equity pay down on the mortgage. For example, on my podcast on Monday's episode yesterday, I was talking about a property that we have for sale right on our website at jasonhartman.com. And it was most of the return that could be considered cash on cash return was in principal reduction every month. Like $290 per month were being paid off by the tenant. And the cash flow was only $115 a month. But together, that's $405 per month. And it made the overall return on the investment on the property really quite nice. But to the untrained eye, because they don't really learn how to do that math properly and realize that a lot of the return on investment is below the surface of the water. They don't see it right away, right? They think, why would I spend, tens of thousands of dollars to buy property that only produces $115 a month? But again, they don't see all of that, right? And so that's just one aspect. There's more to it. There's more than just principal pay down. Of course, the tax benefits, leverage, et cetera. But that's just one example. So you do have a concern about repair expenses and maintenance expenses getting higher in an inflationary environment. No question about it. That is true. But at least historically speaking, the rents have always, in the past, over time, offset that. Now, there may be little small periods, and it's usually an 18-month to 24-month adjustment period. And that's where most investors that don't really get it, they make emotional decisions. And they think, oh my gosh, this property's been great. I've owned it for 7 years, for example. But this last 12 months has been terrible, so I'm just going to sell it. And then they don't do a 1031 exchange because they decided they don't like real estate anymore. And so they pay the capital gains because they have depreciation recapture. And they turn what is really a very nicely performing investment into a bad investment because of their emotionality attached to it, right? And so we've got to understand that as real estate investors, when we are direct investors, we feel the bumps in the road directly. Like we feel it every month, good or bad, right? Sometimes it's great. Sometimes, there's problems and they drive us crazy and they give us headaches. But when you invest in a pooled money asset, you're paying someone else to feel those bumps in the road. And, so if you own stock in a company, the management of that company has all kinds of problems they're dealing with every day. They got an unlawful termination lawsuits. They've got unions organizing. They've got sexual harassment lawsuits. They've got patent infringement lawsuits. They got problems galore. Okay. Yeah. Whatever, right? There's a million problems running a business, but they don't feel that because they're not, or the investor doesn't feel it because they're not directly dealing with those problems, right? But their yield suffers. They pay for it. They just don't feel it directly and emotionally like a direct investor would.
There's two other things too, George. I think it's a lot of the real investors, they might be bitching about the expense increases and all that stuff, and those are all really happening. But let's don't forget the last 3 years, they just had record rent growth and with not that kind of expense growth. So the only thing that's happening is they've already got that delta, from the new, and now it's kind of a lag effect. So most investors, if they're long term, are way in the money right now. If they don't have, let's say, their equity or their debt maturing anytime soon, they made a lot of money in the last 2 or 3 years.
Yeah,
Kenny,
no
that
question.
makes a lot of sense. Yeah, that makes a lot of sense. So, how do you manage your pro forma numbers when you're analyzing a deal? Because Jason just talked about how this property had $100 in cash flow, but the principal reduction was a couple hundred or $300, something like that a month. If it were me, I would be pretty conservative on that principal reduction, because if the nominal value or nominal price of the house goes down, then that's basically what the principal. Let's just say that they pay off 100% of the principal, but if the house is now worth half, even though they paid off that principal, you're not making $300 a month. You're making $150 a month. You see, at the end of the day, if you were to go ahead and sell. So, but I'm not saying that you shouldn't factor that into the equation. You definitely should. But how do you do that? How, are you being more conservative? And if so, how are you being more
Yeah.
conservative
Well,
to
there's
determine what you're willing to pay for a deal?
Yep, it's a great question. So today we went over that same 400 unit deal, and we projected 1% and 2% rent increases over the next 3 years. That's it.
Okay.
Yeah, so we're super conservative. We don't look in the rear view mirror at all and say this is what it's been. We try to take a look at where the market is and all that. The other thing that we don't do in our return is, and I see people do this, and Jason talked about that, is sometimes they'll add the depreciation, the amount of money that they'll save from using the depreciation and or paying down principal. So I've seen that. It is fair. It really is part of the investment. But for us, I always try to solve to the cash on cash, the actual real money coming out of the asset against the real money being put down. And that's what we focus on. And we looked at a couple deals. One was in Tulsa today as well. And what we had there was a property that was built in 2017, where there was at least 6 or 7% in today's rent roll. So in the rents today versus what the actuals were and the people living there, it's called mark to market. So very differently we said, okay, let's just bring them up to what the market is today. The risk, of course, is that market could go down, but there was 6 and 7, I think maybe even 8% on some unit types. So we had quite a bit of room in that rent roll. The challenge or the wrestling match is the seller going to sell it for the actual or the retail, right? And so that's always the battle between that.
Yeah, you know what? I just had a thought based on what Jason brought up with FTX, and it just occurred to me, Kenny, you're probably the perfect guy to ask. And both Jason and I have been entrepreneurs for many, many years. I kind of say that I retired in 2012, but here I am on YouTube. And
this
so
is retirement, George.
Yeah. But
where's your pina colada?
Yeah. I'm actually on the beach right now. This is just a fake background.
Right.
Make it look like I'm not.
Hey, folks,
Hawaii.
George is the only guy that would wear a button-up shirt to the beach.
Yeah.
Just with the record here.
Yeah.
He's got Speedos on too.
Yeah.
But one of the issues with FTX is the commingling of funds with Alameda to a point where, I don't know if this is correct, but what I've heard is customers would go ahead and wire, let's say, $1 million to FTX to fund their trading account. And at the first few months of FTX, they didn't even have a bank account. So those funds were going into Alameda's bank account. And we go to all these, I'm sure a lot of these real estate investors that will watch this have been to so many seminars on how to set up trusts and LLCs and make sure there's arm lengths, between each, and that you're not commingling, taking revenue from XYZ LLC and putting it directly into ABC. And, we kind of get that as real estate investors. but it's just staggering that a $32 billion company was running the business
oversight.
just basically like a mom and pop dry cleaner or something like that. But what do you, I'm fascinated, Kenny, because you run a fund and you take investor money, and I'm sure that, and you take it for multiple projects. So I'm curious, how do you make sure that those funds are going into where they should, and make sure that you're keeping track of all that to make sure that you're not making that same mistake? Now, obviously with SPF order, there's probably fraud involved. So that's a big component, but just the component of the commingling to make sure that you're like, dotting your I's and crossing your T's.
Well, I think one of the key to FTX is that they're based in the Bahamas. And as you start to look around in different parts of the world, which I've done, the local laws, and we don't talk a lot about this, but the actual laws that protect the investors are not necessarily evolved everywhere in many, many areas. And so there are people that go offshore and do things. Now, but to get back to your point, in the U.S., we're pretty heavy regulated. When the SEC, which is how you raise money, the Securities Exchange Commission, they are very, very, rule oriented on when you bring money in, how you treat it, what you have to disclose, and then also there's a compliance with reporting upwards as far as appraisals and annual valuations and things like that. So when you put together a fund, you have all of these things. And I noticed with the FTX piece that I think it was the SEC just tipped their toe in, kind of blessed it, but they don't really have any kind of way to enforce. So I think that was one of the big issues. But in the U.S., it's, there's been problems way back, if you go back 100 years ago, and that's gotten tighter and tighter and tighter and tighter. And really, it's all just to protect the investor. And that's where the accredited investor designation actually came from, was, to try to help solve that issue. And personally, I think the crowdfunding and all the other things kind of make that a little cloudy again, because people can, put $100 in or $1,000 in, and they sometimes don't always know. But for us, we just take accredited investors, and that's it. And it's called a Regulation D.
Yeah. But let's assume for a moment that there was no fraud committed on their end, and let's assume for a moment that there wasn't, the CC component. When I was, it was weird when I was watching this whole debacle and this whole collapse. It almost made me think, I would sure hate to run a fund, because I would be worried about making some sort of mistake, that not just from a standpoint of fraud of it, but a mistake in the accounting, because you've got all these different entities and everything going on that could be detrimental. So, and I'm thinking to myself, if I was in that position to begin with, how would I avoid making those mistakes? Because you guys know how much I delegate.
Yep.
And I can honestly say
it's not just a mistake, though. It's an embezzlement is a big concern.
I'm saying, assuming there was no fraud. Let's just assume for a moment there was no fraud.
Well, I'm saying an employee could embezzle. You wouldn't commit fraud, but your employee could take the money.
Right. There you go, Jason. So, Kenny, how would you, because I know there's a lot of people listening here that are like, they want to be in your position. They want to be like Ken McElroy. That's kind of what they're aspiring to. But there are some significant risks. So how do you avoid those risks completely? For me, the first thing that came to my mind is you just got to make sure there's an adult in the room.
Yeah, that's what I was going to say.
You got to make sure you got a fantastic accountant that has an incredible reputation, that allows you to focus on doing deals and know that the back end is going to be handled, and there's going to be no commingling of funds and all the other things that we saw with this FTX debacle.
Well, when I was 20 years old, George, I thought the SEC was a fraternity. I mean, like, how do you even know what to ask?
They are a fraternity.
Yeah. But Kenny, correct me if I'm wrong, but when you were 20 or whenever you started your fund, at a very
Yep.
young age, you had the wherewithal. You knew what you didn't know. And you knew darn well that, hey, I don't know accounting. And if I'm going to take investor money, I need to hire someone that does. I need to hire an adult here. I need to hire someone that's, maybe 50, 60 years old. There's someone that has a hell of a lot more experience than I do. And I think that was that was the hubris that we saw with SBF, FTX, that obviously contributed to the downfall.
Yeah. For me, it was mentors. I gravitated to people that were doing it already. And the only job I ever had in my life right out of college was somebody who was doing it. And then I went in there, I worked for 8 years, and I just learned everything that I could. I asked a zillion questions from legal to HR to ops to fund to, you name it. And that helped prepare me for the next step.
Yeah, makes sense. So the moral of the story, make sure that when you go into a venture, you have humility and you try to eliminate ego and know what you don't know. Jason, do you have any stories like that? I mean, how do you structure what you did?
Yeah.
You started doing this at like 15 years old. So how did you know?
Actually, I was 4. 36 years ago, I was 4. Okay.
Yeah. So how
Anyway,
did you know how to make sure that you were dotting your I's and crossing your T's?
well, first of all, you just make a lot of real world mistakes and you learn your lessons, frankly. I mean, look at no matter what you do in life, you will never figure it out before you do it. Most of life is on the job training. Okay. That's just the reality of anything in life. And, Kenny learned as much as he could. You learned as much as you could. I learned as much as I could. Everyone watching, we all do that, but we're just going to learn way more when we're really doing it. We all know that. Okay. And to your point, to your question about, the FTX thing, I used to own an escrow company. And I tell you, that was a very profitable business, but I was very concerned about that trust account. It's the only time I had other people's money in trust. And I remember we opened that escrow company and, almost right away we had about $12 million in the account. And I was much younger then. So that seemed like a lot more money. And you could adjust for inflation. It was a lot more. Okay. And, I thought, gosh, what if an employee embezzles? What if, that the accounting isn't right? And what's amazing about that, and this was in California, there's 2 types of escrow companies you can own. One is a DRE, Department of Real Estate escrow company, and the other is a DOC or Department of Corporations escrow company. And I had the DRE kind that you can only escrow your own transactions that your company was brokering, so it always would be smaller. But I did investigate doing a DOC escrow, and here's what I want people to know about that, is that your money, even in the US, is not really that safe. And we all know about the fraudsters in the US. We've all heard the stories, right? I don't need to repeat their names: John Corzine, Bernie Madoff, Enron, et cetera. But you had to post a bond to be a big DOC escrow company. And the bond amount, get this, was only $35,000. That was shocking to me, that if you could get a bond for $35,000 and jump through a few other pretty easy hoops, you could just take millions and millions of dollars in people's funds into your escrow account. And there are examples of escrow companies just absconding with that money. The other one is 1031 exchange companies, those intermediary companies. They have zillions of dollars in their accounts sometimes, and they're not even regulated. I mean, it's really quite risky, people. You need to be careful. You need to really watch for the reputation and make sure that there's a maturity of the person you're putting your money with, and there clearly wasn't with FTX. I mean, it just comes down to this idea that people just essentially want something for nothing. I mean, on the FTX thing, I don't know how anybody could think with Binance or FTX that someone offering you these ridiculous returns. Like I saw a Twitter post, George, I think you were actually tagged in that one, of I can't remember who it was, showing I believe a Binance ad for offering a 104% annualized ROI. I mean, who is the counterparty that you can make 104% from? Like, just think about what is the flip side of that transaction? Who is the counterparty that is going to give you that type of return? That's just obviously illogical. Nobody's going to pay 104% to borrow money or use money or whatever, right? It just doesn't happen,
Yeah.
you know. So
Well, yeah. I mean, it's fascinating to see how this is going to play out. I'd keep going on this, but I don't want to go too far down the rabbit hole. Let's talk about some macro stuff, guys. I kept mentioning the yield curve inversion, and just so we're all on the same page here, because I know this isn't a macro channel, what you have is different maturities on the Treasury curve. So you've got like a 1 month Treasury, you've got a 1 year, a 2 year, all the way out to 30 years. And as you can imagine, if you are lending to someone for 30 years, you're taking on a lot more risk and a lot more inflation risk and risk that you won't be paid back and whatnot. So you would assume that the interest rate, if you're lending someone 30 for 30 years, would be far, far higher
much
than
higher.
if
Yeah.
you're lending someone money for 1 month, let's say. But what we see now is the yield on a 30-year treasury is not only trading lower than the 1 month treasury, it's trading lower than RRP. Now, what is RRP? Well, the Federal Reserve, since they started quantitative easing in 2008, they no longer have a set Fed funds rate. It's a range of about 25 basis points. So when they say that the Fed funds, they're raising rates to 3.75, that's really a range between 3.75 and 4%. So what they do now is they have something called IOR, which is interest on reserves. And this is what you always hear the Fed is paying the banksters to hold their quote unquote cash at the Fed. They're paying them right now 3.9% as we speak. So how does the Fed manage interest rates, right? If it's this range, and how do they make sure that if they want the lowest interest rate in the economy to be, let's say, at 3.8, how do they do that? Well, this is something called reverse repo, where they say, okay, guys, we'll pay you, let's say money market funds, 3.8% for parking your cash at the Fed, and pretty much completely risk-free. And so their idea, the thought process is, why would anyone lend to anyone else, or why would anyone, buy a bond when they could just take that same money and park it at the Fed and get 3.8%? Why would they do it at a lower interest rate? Why would they do it at 3.5%? Makes no sense whatsoever. But what we see right now is not just the 10-year, but the 30-year Treasury trading under reverse repo, which is supposed to be the way the Fed sets a floor on interest rates for the entire economy. That doesn't happen in a healthy environment. that happens when there are some massive distortions going on and a lot of tectonic plates are shifting. So Jason, when you told me that you've been in this game for a long, long time, and you've seen ups and downs, and you've seen bull markets, bear markets, you've seen cycles. And so when you said at the beginning of this show that this housing market right now is unprecedented, it's something you've never, ever seen in your life. Based on what I'm seeing in the macro world, I'm not surprised. That makes a lot of sense. So, Kenny, I know you've been giving this some thought on your end. How are you thinking about it? But then maybe how do you think about what could happen to interest rates in 2023, assuming they come back down, which is what the yield curve is actually predicting? And I've got some things to add to that, but I want to hear your thoughts first and foremost.
So, first of all, there's a we've bought properties. This is our 21st year in business, so we've bought properties at 7 or 8% before, and then we have benefited from the rates going down and refinancing at lower rates before. And so that's why we're still in the game, George. If we can buy something today at 7% and make it cash flow, then one, we hedge the interest rate going up and it's cash flowing, and if we've underwritten it correctly. But two, if it does go back down, let's say to 5 or 4, then we can pull that cash out, and we actually can pull cash out and actually have a lower payment, and our cash flow goes up, which I've been through before. So that's why we're always looking and always buying and always use the exact same model when we're trying to buy from a cash flow standpoint. And if it cash flows and we have enough cash reserves to make, for any mistakes that we might have made, then we're going to be fine. And then if rates do come down, and I agree with you, I think they probably have to at some point, then we'll just capitalize with a lower payment at that time.
Jason, how do you do that from the residential side? Because I know Kenny's talking about a $100 million loan or something. So the costs to refi are just insignificant. But with maybe a single family home, maybe the costs don't make sense unless interest rates go down by a certain amount. And I'm sure you probably have some sort of formula, some sort of trademark formula for this. So what's your secret?
And I gave it a special name.
Of course you did.
Probably too. Yeah.
The Hartman Index.
Right.
Yeah.
Right.
Or refi till you die. Yeah. Yeah. No, I mean, look, there are many factors besides just the rate, right? And, what are your plans for the property? What's the overall market? What are you thinking? Are rates going to be lower or higher in the future, et cetera, et cetera, et cetera. But the one thing I absolutely love about income property, and it's just such a special asset class, because the deal you agree to, is never the deal that's final. You can constantly renegotiate the deal throughout your ownership of the property. With other assets, when you do the deal, I mean, you buy a stock and that's the deal. Okay, it's done, right? You better hope that stock goes up in value or pays you great dividends, or hopefully both, right? But with real estate, you can buy it now and complain all the way to the bank about the interest rates, and you might be justified in doing that. But next year when we head into an official recession, right? When they start calling it a recession, and rates come down and things go the other way, you can just renegotiate the deal by getting a new rate, right? So you're never stuck with the exact deal you agreed to. And that's what's great about it. I mean, people that enter a deal and then constantly change the deal, we call them weasels, right? They're not good people to deal with, because, they keep renegotiating the deal after you've made an agreement, screw them. But on this deal, you can renegotiate the deal all the time, and you can improve the property creatively. You can offer a different type of lease, like a rent to own option. With Kenny's properties, and Ken, I'm sure you probably have done this sometime in your career. I don't think lately, but in the past, maybe you could convert them to condos, right? Like your deal could just become completely different. You can rent out storage units. You can make 5% or 10% of the units in your apartment complex short-term rentals or corporate apartments, right? And you can constantly just renegotiate the deal. You can improve the property and raise the rents, re-tenant it. There's just all kinds of ways. You are never stuck to the deal you originally agreed to, which is awesome.
Yeah, it's interesting. Most people, I don't know, they think through the complete asymmetry with a 30-year fixed rate loan, meaning it cannot go up in price. It can only go down, or in interest rate.
Well,
right?
Actually, George, to be fair on balance, and we don't usually think of it this way, but in a deflationary environment, it does get more expensive, right? We both know that. So it could get more burdensome to have that debt. It's unlikely, given government spending and money printing, that that'll ever be an issue, but it's theoretically possible.
Fair enough. Fair enough.
Yeah.
As long as we're borrowing in dollars, we're fine.
Yeah. Yeah. Yeah.
Yeah. Yeah.
Or an FTT.
Or FTT, right? Which is their FTX's token, which has basically gone down to zero. That would be a great bet to borrow in FTT or borrow in Dogecoin or something like that.
Yeah. Or Shiba. Yeah.
Yeah. So speaking of, I won't go off on a tangent there. I was going to say, you're the dog guy. I can't believe you haven't done some sort of digital token or NFT about your dog.
Hey, we need a dog coin. Another one. Elon Musk likes the dog coin.
Yeah. What's your dog's name again?
Coco. You don't even know my dog's name. Can you believe this guy, Kenny?
We're kidding. That's what we need. We need a Coco coin.
A Coco coin.
That's right. Absolutely.
Coco's crypto.
Yeah.
Somewhere, yeah.
So, Jason, what you got an event coming up that sounds super exciting.
Yep.
What type of topics are you guys going to be discussing, and kind of what's the itinerary there?
Well, we've got some great speakers: George Gamman, Ken McElroy, and not present Tom Wheelwright. And it's going to be an awesome event. And it's in Scottsdale, beautiful Scottsdale, Kenny's home and George's former home and my former home. Last weekend of January, 2.5-day event. And I've got a special offer that ended yesterday, but I want to extend it for people watching this live stream. We've got almost 700 people on right now live with us. And if you go and you buy a general admission ticket for the event, we will offer you the BOGO deal, which is buy one, get one. Okay. So you can bring a guest. Listen, you can bring your wife, you can bring your mistress, just don't bring both. Okay. Yeah.
BOGO.
And if you go get one of those general admission tickets before midnight, it's 2 for 1. Okay. And we did do that as a Cyber Monday deal. It ended yesterday, but we'll just know if you bought it tonight that you got the 2 for 1 deal. Okay.
Yeah.
So
if you're interested in real estate, I cannot recommend this enough because, we're going through some tumultuous times, but the good news is that's going to present a tremendous opportunity for those who are prepared. And I think that's probably what your focus is going to be at this event. And then,
no question about it. I want to tell you about one of the other speakers that's really interesting that you guys don't know. But this is Rudyard Lynch, okay? And he runs a YouTube channel called What If Alt Hist, like What If Alternate History. The guy is fascinating. He's got 459,000 subscribers, okay? Almost 500,000 subscribers. His channel is awesome. I highly recommend it. He is the youngest speaker we've ever had. The guy is 20 years old, okay? And I am so impressed with this kid. He's just brilliant. He's been on my show before, and his videos are awesome. Tonight, before this interview, I watched one about baby boomers, and he is just a total student on demographics and geopolitics and economics. You're going to love this guy. And he is also speaking at the event in Scottsdale. And then we're going to announce some other speakers too. So yeah.
And Kenny, you're going to be there.
Yeah.
IRL, right?
I just spoke at the IMN conference also, George, and I'm actually taking more speaking because, to your point, I'm learning. I want to be in the same room listening to these people about what they're experiencing, and things are changing. So it's important. That's why I'm going. I would have gone if I wasn't a speaker. I'm trying to learn just like everyone else. I don't know everything. I do all my research, but every time I go to something like this, I get nuggets of wisdom. My network gets bigger, and I'm like everyone. I'm trying to mitigate risk and take advantage of some opportunities and try to see where they are and see what other people see. So this kind of stuff, especially now, is really, really important, I think. And it's important that people stay on top of this.
Yeah. And guys, in case
Kenny,
you
to
didn't
your
catch
point,
that humility and lack of ego is one of the reasons why Kenny McElroy is so damn successful. I can tell you that right now.
Absolutely. Absolutely. And Ken, I love what you said about how your network grows. It's not just the education, but it's the social aspect, the fun. I mean, conferences, I think, are really fraternity parties for adults. I absolutely love going to conferences. They're so much fun. They're some of the funnest things I do. And the event's going to be a lot of fun, too. We're going to have a band on Saturday night. We're going to have cocktail party Friday.
Are we doing something for the collective?
Yeah. We have a bunch of the collective members coming.
Yeah.
Oh, it's in case. So for those of you who don't know, the collective is the mastermind group. There we go. That the three of us have. So if you want to check it out, I guess you can just scan that QR code. But
I love the QR code.
Yeah, that's a good idea. But we'll be talking more about it at Jason's event. And I think we might be doing a special dinner at the event as well. Is that the case?
Yeah. We have a bunch of members coming, so part of being part of the collective is coming to all of our events. We all do live events, but also we do 4 very deep dive, full access events just for collective members. Yeah. And if you want to learn more, you just come there. We'll have a booth and everything. It's going to be fun. But yeah, it's been really, really a great experience for all of us.
Yeah, sure has. Yeah. Sure has. All right, guys. So I guess we'll go around the table here and say, what is the one thing that you would prioritize for a real estate investor being cognizant of going into 2023?
I'll go first.
Yeah.
Because I just did this last week. So my partner Ross and I, we went through every single asset, looked at all our equity and our debt maturities. And you want to be way ahead of that. So if you have a loan, let's say that's maturing at the end of this year, which you would know obviously, but next year, anytime next year, you got to be prepared for that. So whether it's a bridge loan, variable loan, whatever it is, even a fixed loan that's maturing, the same thing on the equity side, because a lot of people use managed equity. And like if I borrowed money from George or Jason, there's a time frame on it. They want it back, and they want it back with a return. So a lot of people don't think about equity, but managed equity, there's a time frame on. So those are 2 things that we looked at very, very hard, and then you have to create a plan around that for each asset.
Yeah, Jason, what do you think, buddy?
Yeah, that's good advice. I would just be looking at the overall market and being really cognizant of housing inventory levels, because I think that just tells you so much of the story. Right now, the inventory of homes on the market is about 50% of what it was in 2015, 7 years ago. And in 2015, we were complaining about how we didn't have enough inventory. And all of the resale properties in the country virtually have 28 to 29 years left of extremely low interest rate mortgages. So they're not going to be very motivated to sell at all. But the new homes are where the opportunity is now. Those are the sellers that are more motivated, and we are cutting good deals with new home builders. But as far as that's for opportunity for buying and thinking about which way the market's going. But as far as the properties you own now, be a good manager of your properties. And if you have property managers, be a good manager of your managers. Be prudent, pay attention. This is a time where you've got to be paying more attention than ever before, because times are changing. And we're gonna go over a lot of this stuff at Empowered Investor Live at the end of the month, at the end of January in Scottsdale. I just want to give out that link again, guys, because it was only up on the screen for a moment. It's empoweredinvestor.com/live. And if you go grab a general admission ticket now, that'll be 2 for 1. before midnight tonight, Pacific time, so 3 a.m. in the East Coast. And we will go ahead and make that for you. So empoweredinvestor.com/live or jasonhartman.com. You can also go there. And we just look forward to seeing you there. And George and Ken and I are going to put on a great show for you, and all our other speakers too. So Kenny, I really appreciate the opportunity to be on your channel, of course. And George, thanks for all the great questions and for kind of emceeing this.
George, before we go,
happy investment.
What do you see, George? I would love to know your perspective before we wrap up here.
Yeah, the one thing I would suggest real estate investors pay attention to, and I'll probably be addressing this at your event, Jason, because this kind of moves in real time, is going back to that yield curve. We talked about how it's inverted, but I think what people really need to pay attention to is where in the curve it starts to invert. Right. So the last time I looked, which would have been last week, the rate on my memory serves me right here, but it's the concept that matters. The rate on the 1 year was higher than the 2 year. So that's the point in the curve where you started to see an inversion. And then everything from the 2 year down was a lower interest rate than the 1 year. So what this is doing, this is the bond market predicting when the Fed is going to pivot. So notice when that moves further to the left, or when that point gets shorter and shorter and shorter, or moves closer to the short end of the curve, meaning that inversion goes from the 1 year to the 2 year. Now it moves, let's say, from the 6 month to the 1 year, meaning now the 6 month is higher than the 1 year, and then the whole curve is down from the 6 month. Then that moves to the 3 month, then that moves to the 1 month, then that moves to the Fed funds rate. That's the market telling you that that's how much time we're betting that the Fed is going to go before they hit the pause button or start to pivot. So it's not a precise timing thing or anything like that, but it's the best we've got. So if you're trying to figure out, when are rates going to go down, if they are going to go down, just watch the bond market and watch that point of inversion like a hawk. And we'll be doing an update at Jason's seminar, and I'll be going over a full analysis then.
Oh, that's going to be great, George.
Looking forward to that, George.
Yeah, that's going
really
to be fascinating.
Important stuff.
That's what everybody wants to know is that. So thank you. So, hey, guys, awesome. I appreciate this. We're going to do this again soon on one of your guys' channels, and can't wait to catch up and see what happens next.
Looking forward to it, guys. Happy investing,
Cheers,
everybody.
Guys. Happy investing.
Thanks
See
for
you
watching.
Soon.